Thanks for tuning into NDTV Profit. I'm Neeraj Shah, and we're talking to a business, or there are businesses which are in a state of transition despite having achieved significantly in the life cycle. And Syngene is one such business which has unequivocally been a leader in the biologic CDMO business, and now they are transforming themselves into not just a CRO, which is a contract research organization, but also into manufacturing CDMO, that is, in a meaningful way. And to talk about how he sees Syngene moving from what it is currently to what it could be a few years down the line after having finished 30 years of their existence is Jonathan Hunt. Jonathan, great having you. Thanks for taking the time out.
Yeah, it's a pleasure to join you.
Yeah, and Jonathan, congratulations to you and Team Syngene. 30 years, I presume, is a momentous occasion, but I'm guessing you're looking forward to the next 30 already.
Yeah, I mean, it's worth taking a moment of reflection and enjoying some of the sort of progress we've made over 30 years. We certainly took some time last week to celebrate that and enjoy it. It was a pleasure, actually, how many of the very founding staff are still with us. I mean, they're a little bit gray-haired, and they've been there quite a long time, but it's a pleasure to sit down with some of them. And they've seen so much change and transformation.
Okay.
I wonder what the next 30 years will bring.
Yeah, it'll be interesting. So tell us, what do you think? I mean, when you look at what's gone by and what you are on the cusp of, or have events that have led you to be on the cusp of something which is different than what the previous few years of Syngene have been, how do you think about the next few years?
Yeah, I mean, sort of, you described it in your comments as on the cusp of transformation. That feels a bit more sort of precipitous than I would describe it. I think it's an evolution, and it's the reason that's important is it's got a sort of consistent theme through it, and it feels organically natural that we should evolve the business in this way. We're pretty much following the way science flows, and we're following the way that our clients, our customers naturally create value in their business. They start with an idea, that innovative spark, often it comes out of academia or it comes out of their own discovery. You have a hypothesis that, if we take in human health, a particular biological understanding of a disease, and if you can interfere with those biological mechanisms in a way, you can create a drug, a medicine that's useful, you can get a clinical outcome that helps the patient. So they start with those ideas. They go into years of discovery. That's the R&D, or for us, the CRO bit of our business. Scientists in laboratory, prosecuting scientific ideas, running experiments, trying to uncover the truth of the disease. And then they move the next phases into development. How do you take the molecule you've now found and turn it into a medicine? Go from the chemistry to the patient, and that's around finding out how do you make it? How do you make it at scale? What form do you put it in? Is it a tablet? Is it a capsule? Is it an injection? What helps the patient best? And then, of course, doing the scientific clinical experiments to prove that it actually brings that benefit in the disease. And then you move to distribution and manufacturing. So that's a decade-long workflow for our clients. And it flows in one natural direction, and that sets the template for really how Syngene is evolving as a business. CRO to CDMO to CRCDMO. There's so many abbreviations, but fundamentally follow the science, head towards where the patient and where you can have a positive impact.
Yeah, well, which is great to know, but I'm just trying to understand, Jonathan, is heading towards the patient from an investors and a shareholders perspective, which a lot of our viewers would love to understand what kind of business opportunities and challenges does it bring for an organization which has been, in abbreviation terms, a CRO, but moving to a CRO plus CDMO brings.
Yeah. Oh, there's multiple dimensions to that. I mean, there's the natural workflow. You hand over from discovery research scientists. As you move closer into the development manufacturing piece, the reproducibility, the rigor at which you operate. If you've ever been around a lab or you've ever been around a manufacturing plant, you can almost in your mind picture the difference. Often in this, the scientist's office is a million ideas and almost as many papers and research. It's about how do you bring together all of those ideas and think them through. Manufacturing environments tend to be highly regimented, a place for everything, everything in its place, and you have to bring that operational and industrial rigor. And in our industry, almost more than any other, but certainly the match of any other, you overlay a regulatory framework. The FDA in the US, EMEA in Europe, the Indian regulators, the Japanese, many, many regulatory bodies around the world place a high degree of control and rigor around how you operate in the manufacturing environment. So you've got to be able to do both. And that means that you need different skill sets, different processes, different systems. And that's part of the evolution of Syngene. It's one that I think we're doing well on. Evidence for that, even in the last year, we've had 2 of our manufacturing facilities pass their first ever inspections by the US FDA. That's quite a seismic event for any business getting to that standard. We now have the same regulatory status, I think, as any and all of our clients, with our ability to manufacture to the very highest regulated operating standards in the world on both small molecules and large molecules. So we're building that track record, we're building the underlying capability, and that allows us then to offer something that's of real benefit to our customers, which is to flow seamlessly from the research work that we've done for 30 years for them and take that project all the way through towards the patient. That means you can be a bit quicker. And in an industry that's patent bound, it's time limited. Every single day counts about getting to the patient. I think there's a moral imperative. If you've got a good product, a good medicine, getting it to the patients as quickly as you can is a good thing from a societal point of view. But our customers are also very, very conscious that time lost in discovery and development is time off their patent clock, makes a big change to the economic value. So having those things in one integrated organization allows you to move quickly towards the patient, and it allows those learning loops between the different stages, the feedback loops in how you do work, to get you there quicker in a better risk managed way.
Okay. I have 2 follow-ups to this, Jonathan. The first follow-up is whether this transition to manufacturing is happening at a pace that you would have earlier envisaged, or is it a relatively slower pace, if you believe it is, simply because you are gathering all the tricks of the trade around it, and then you will set the base and then try to kind of get a J-curve effect. What is happening there on the manufacturing side?
Well, yeah, it's a good question. I think overall, it's evolving around the pace we expected. Certainly, it's in line with the sort of guidance and the narrative of conversations I've had with investors and shareholders and with the board. Within that, of course, there's always swings and roundabouts. I think over the last 2 years or so, our biologics manufacturing businesses is surprised us on the upside. It's moved a little bit quicker. And I think the small molecules is maybe a little bit slower than I would have hoped, but the combination of the two means we're evolving at around the rate I would have expected. And that's, it's pretty much in line with internal and external expectations.
Yeah, no, okay, I think the conversations that I've had with some investors, and by virtue of the fact that what you've done in your recent past, Jonathan, or not recent past, let's say the last 8 to 10 years, and the pace of growth that you've shown leads people to believe that even on the small molecule manufacturing, Mangalore API, et cetera, the pace of growth, going by your own standards, should be a bit quicker. I'm just trying to understand, do you think that you're moving at a pace which is by design, or do you reckon that at some point of time you will canter at a faster clip on the manufacturing small molecule piece?
Yeah, it depends on the context of the question. Would I be happy to go faster? Absolutely.
Of course, yes.
Are we ready and capable to grow quicker? Yeah, I think we've got the depth, the capability, the capacity, the skill sets to do it. So from that point of view, I think I've got common cause with my investors and shareholders. more growth sooner would be a good thing and something that we could deliver on. That said, manufacturing business development cycles are just fundamentally different in nature from the way that the research services business grows. To characterize it, one of them is thousands of experiments, hundreds of clients, short-term immediate projects with a high sort of dynamic variability. Manufacturing is much more long-term and glacial. To take the partnership that we signed with Zoetis, our first manufacturing contract with them is a 10-year deal. You just don't ever see that on the research side. So they come in big blocks of growth, and you only need to string 1, 2, or 3 of those together, and you're in a very, very different position. So I think we've got to be comfortable recognizing those two markets have very different dynamics.
Yeah, and okay, just one last piece on this, and then in the next segment, I would love to talk about how you think about all of these things as you look at 5-7 years. But just one small follow-up on this piece as well, Jonathan. Yes, it's a different kettle of fish. So to your mind, do you reckon this is, for now, the pace of growth on the manufacturing side that you would be happy with and move ahead as you wait to stitch other partnerships? And part two, I mean, Zoetis was a landmark one. Do you reckon more such things are coming in the near future for Syngene?
Oh, I think deals like that reposition the company in the market's eyes. We've had a lot more contact across the manufacturing world post the Zoetis deal, post the FDA approvals for both Mangalore and the small molecule business and also the biologics. That opens doors. That's not a comment on the near-term deal flow and pipeline. I just wouldn't get into that level of description. But you're much more credible as an organization, and you're positioned differently when you've reached the highest standards that are achievable in the world from regulatory review and approval, and you can actually say every single day, every week, every month, we are manufacturing and shipping sophisticated drug substance in the biologics and shipping it into the US marketplace. It's a bit binary. Prior to that, you've got hope and aspiration. After that, you're a proven supply point, and people will see you as such. So that's not a comment on near-term deal flow, but it was a big step forward in terms of the credibility and therefore the relevance to customers to achieve those things. So we're in a different position. Equally, we've got to recognize that all happened in the last 12 months. So we're a new entrant in this sphere, and we've got to build our brand, build our reputation. And those conversations can take a long time. The Zoetis contract would have been actively under negotiation for the best part of a year. So you just if you have to temper the thought around how quick is quick in those sort of deal-making scenarios.
Okay, so since you are looking at this from a really long term as a company head honcho should, I'm presuming that you personally believe that these rates of growth currently as they are, because you're venturing into an area which you've not been present in the past, you're happy with these growth rates as you're building out that base for this business at the same time while you are cracking some fairly landmark pieces like Zoetis, for example?
Yeah, I actually, the way I look at it, I take my mind forward to 2 time points. When you build a manufacturing plant, you're building a 30-year asset, 30-year plus.
Right.
So in good faith, I have to answer to myself and to my board and my shareholders, do I believe if I look back 30 years' time over the life of the asset, will we have consistently created value beyond the cost of capital? I genuinely created shareholder value, and have we got good reasons to believe that? And that's the basis that we make investments on, and we put our shareholders' capital to work. We think manufacturing as a business over the life of the assets that will create sustained value. We think there's visible signs of not only demand, but growing demand. We think over the next 10, 20, 30 years, there's every reason to believe the market's going to be ever more comfortable having that manufacturing done in Asia, in India. Over the next 10, 20, 30 years, every reason to believe the Indian domestic market becomes a growing one. We've seen that in other Asian economies. So you look at those fundamentals, that's quite a long-term perspective to take. The other time point is the business cycle. We tend to think in 5-year business plans. You mentioned that earlier in your comments.
Yes.
Over the last 5 years or so, we've done objectively well, I think, by anybody's standards, both in shareholder value creation. We're certainly upper quartile, I would think maybe even upper decile in the industry group that we're in. We've more than doubled the revenue, we've more than doubled the headcount, we've more than doubled the number of customers over that business plan. So then I go out 5 years and look back. I'd expect to have a in place, fully functioning, well-established, high occupancy, high utilization of the assets that we've built today and have just brought online. Between those two, you've just got to interpolate, and that's sort of your question. I'm comfortable that 5 years' time we'll get there. What that path will be week by week, month by month, I think we're going to find out empirically.
Okay, point well taken. We'll talk about this and more on the other side of this very quick break. Stay tuned, viewers. We are in conversation with Jonathan Hunt of Syngene. Welcome back to this conversation. We are talking to Jonathan Hunt of Syngene. And Jonathan, you were talking about looking at 2 time points in the future and then looking at growth empirically, and you believe that it would work out as well, if not better, than what you would have done in the previous 5 years as well. Now tell us what could be the mix of what Syngene could be 5 years out, because you will no longer be a research-dominated organization because there will be a large manufacturing presence. Is there an internal mix target that you and Team Syngene have?
That's a good way of framing it. There's not a target. There's an expectation that, and I think we've talked about this before, we're becoming a twin-engine plane rather than a single engine. And that allows you better balance in your organization. It's more resilient. But it will mean a rebalancing. Now, my expectation, at least how it's evolved so far, that's both sides of the house growing, but one, because it's newer, growing faster. So the rebalancing comes from 2 levels of growth rather than one bit of the business is slowing and falling away and the other one is supplanting it. So, we just celebrated 30 years in business last week. For the first decade, we were largely not even a fully built out research services business. We were very chemistry centric, chemistry services. And that therefore, when I joined the company 8-9 years ago, the research services was the vast majority of the revenue and certainly the vast majority of the client relationships and profit in the business. If you look at it today, it's much more evenly balanced, with development and manufacturing getting up to, 40% or so, something around that of the business. We'll get to 50-50 pretty quickly, early in the next 5-year plan, I would have thought. And then I actually think, because manufacturing tends to be longer buying cycles, longer sticky client relationships, but it's much more scalable than the discovery research side. So if we exited the 5-year plan, actually having reversed those percentages wouldn't surprise me at all and would be a reasonable outcome and quite welcome. So, 5 years out, can the development manufacturing, the CDMO bit, actually be the largest part of Syngene? I think that's very possible.
And this is happening at the same time when you have been on record, or at least in the call, saying that you would invest $100 million annually in research and biologics, at least in FY24. And you telling me in the past that it's not just that the West is coming to East, but on the research side or on the manufacturing or both, but East is going West as well. So it's not that that piece is not growing at a fast clip. It's just that the other piece, which is manufacturing, or the other engine, will power the plane a lot more than the first one.
Yeah, that's the sort of direction and the message I'm giving. That said, you know, the research services part of the industry at the moment depends which lens you put on. If you put 5 years on, I think the demand is unabated. There's every reason to see things are going, continuing to grow. There's great scientific ideas coming through. The world continues, the population continues to grow, economies are growing. People will continue to demand new and innovative medicines and solutions to their healthcare needs. If you put a lens of the next 5 months, then I think we can already see that there's some quite choppy waters in the US, particularly in the biotech sector, around private equity, venture capital funding. That startup environment is quite slow at the moment as they're working through a new funding environment. But that looks to be highly temporal. You know, that's a 5-month phenomenon, not a 5-year one.
Which explains that while they might be having cut in guidance for FY24, that may not necessarily be the outlook for FY25.
Yeah, and you know, it would be a brave person to call it specifically on the timing, but what it feels to me a little bit, we've just been through a global pandemic. Running into the pandemic and through that period, we've probably had we had a 1 in 100 year or longer event with a pandemic, I hope, but we've also had a 1 in 100 year funding peak going into biotech. There's been an enormous step up in the last 3 or 4 years of biotech funding. It's a bit of a hangover, headache as you come out of that. But there's every reason to think that it's normalizing about where it was back in 2017, 18, 19. So the new normal looks very much like the old normal. And that was thought to be a stable, vibrant, you know, buoyant position for the world. It's just very different from a 2-3 year, I think, pandemic accelerated peak. Now, of course, for the businesses that are going through it, they've got to adjust. Those that have got funding are thinking very carefully about how they can eke it out, stretch it. Can they get better value? So they're looking for solutions that are ever more affordable. That's not a bad position for a business like ours. Those that don't have funding, of course, are having a much tougher time raising the capital at the moment. But the early indicators are on that, is even that environment starting to stabilize. But I don't know. I think we need a couple more quarters before anybody's going to be really clear on where that's settling out.
Okay, I have 2 minutes with you. 2 quick questions before we wrap this up. One, the world at large seems to have changed, even though we are looking at interest rate cuts coming in possibly in 2024, Jonathan. The fact remains that funding costs for organizations worldwide have moved up from what they have been in the last 2 decades, presumably for good right now, but who knows? I'm just trying to think if corporations like yours, how are they thinking about the internal rate of return for projects, for funding, for debt, or raising capital in order to fund projects? Is there a dramatic change in thinking that has come into Syngene as well for the same?
If you go back to my earlier comment that particularly with capital deployment, where the asset has got a 30, 40-year life, I don't think anybody adjusted their internal rates of return down to interest levels that were driven by a temporal effect like quantitative easing. We've had low interest rates for a decade or more, driven by government intervention around the world with QE. But if you looked over the entire sort of business cycle, your internal rates would have been higher than that anyway. So, you know, when we look to make cost of capital returns over 30, 40 years of an asset, we're setting hurdle rates that account for what are long-term interest rates, long-term cost of capital. And and therefore it's higher, inherently than it would be just because of quantitative easing. That's a bit of an economist answer to the question, which is, I don't think anybody chased cheap capital as a reason for investing. You've got to be able to create sustainable value over the long term.
Most certainly. Before we wrap up, Jonathan, I know it takes, as you said, a brave man to try and predict timelines in a world as volatile as this. But we know about what you've guided for FY24 already. I'm not looking for a specific guidance, but do you reckon that if the biotech troubles wane as things shape up in the next couple of quarters, could FY25 and years beyond, by virtue of all the tailwinds that you have around both research and manufacturing, be as near to normal, let's say, what you've done in the last few years, or is it difficult to predict that right now?
Do I get to repackage your question and give you the...
Yes, please do that. Do it your way.
I'd look more over the next 5 years.
You already said.
I think we've put in place the right strategy. We're executing on it, and we now have the right enablers. Not only the people and the infrastructure, but also the regulatory approvals now, and the beginnings of those sort of client connects. That 5 years from now, I think we'll look back and we'll have created the sort of magnitude of growth that we've done over the last 5 years.
Yeah.
Now, I didn't give you a dollar number, but I gave you a sense that I think there's every reason we'll continue to grow over that next business cycle.
Yeah, and you did tell me earlier, which I kind of missed out, that whether through that period, whatever the growth rates may be, but empirically, when you look back 5 years out, it'll look similar to the growth rates of the previous 5. So I take on board that. Thank you so much, Jonathan Hunt, for joining us today. Wishing you a great holiday season. Festive greetings to you and Team Syngene. And thanks for speaking to us on NDTV Profit.
Pleasure.
The pleasure is ours, viewers. Thanks for tuning in.